Adam. Okay, well, we'll just get started then. That way we respect everybody's time here. Thanks for having us today. Truly appreciate it. Obviously, I'm Chris Woodhouse. I'm your BDM for the alternative spot. As mentioned, I brought Adam on today. Adam is handling our prime stuff. Adam, do you want to say hello?
Hello, everybody.
I think most people would know Adam, I think, from his previous life. Yeah.
Well, Ali, I don't know about everybody else.
Oh, okay. Well, we're fortunate to have Adam. Adam's been with us for just over a year now, so we're pretty happy about that. Let me just see. How do I? Sorry, I'm just trying to share my screen here. Let's see here. Oh. Sorry, I'm not used to this particular one that we're using here. Can you see that or no?
I can see it, yeah.
Yep. Yeah?
Yep.
Okay, perfect. I'm going to go through our alternative platform today, and then I'm going to pass it over to Adam so that he can go through his stuff. So we started Aspire, which is our alternative platform, about 12 months ago. Aspire as a whole, when we first launched, was very mickish, very niche-y. I would say that we definitely need to expand the investor roster for sure in order to be competitive in the market. We've done that, and we're going to continue to do so. My ask of anybody listening to the recording is if you have any feedback with respect to spots that you think that we're missing, please don't hesitate to send me an email. It's cwoodhouse@strivecapital.ca. And we are looking to grow the product. And again, we are constantly in connections with different investors and trying to grow the product. The way I see our product today is almost like a three-tiered approach. So we've got Aspire Alt, and then we have Aspire Advantage. So divided up into two different categories, but I look at it as a three-prong approach, which I'll talk about in a moment. Aspire Alt is available in Ontario-based only, meaning that would be a credit union investor. The reason why I let everybody know that is because when you get your commitment back from the underwriter, you will see a membership agreement. Obviously, if you've dealt with a credit union in the past, some of you would have dealt with Adam at his last job, you would have had to sign a membership agreement form in order to have a product with a credit union. Now, there is a $25 fee for that. We obviously cover that, just the cost of doing business. So there's no cost to a client, but I do like to bring that forward because, again, it is a credit union investor. So top tier, meaning our alternative alt stuff, is Ontario-based only. Aspire Advantage is more of a mixed style product that's available in Ontario, Alberta, and BC. Okay. We're going to start with our top tier stuff, and I'm going to start with our contract qualifier. So these are the folks that are just missing out on Adam's side. So just missing out on the prime side. Contract qualifier, exactly as it sounds. We're there just to qualify on the contract rate. We do refis and purchases. Please note that this is for owner-occupied only and confirmable income only. We're not going to do stated income under contract qualifier. We have a 2, 3, and a 5-year rate. Max AM that we utilize under this program is 30 years. And the GDS TDS requirements are 39.44. So very similar to Adam's side. We don't have a lot of flexibility there, but it's good for the folks that are just missing being on the prime side. Our initial launch with this product was actually done up in Ottawa. When we first launched it, we saw a ton of deals, a lot of government workers, obviously, a lot of folks that don't have a ton of bonus or overtime and stuff like that. So just qualifying under the contract plus 2 became a challenge. We launched this up there and it's been a big success. And now we've opened it up to just a lot of other spots across the board. Okay. So when you think about Alt A contract qualifying, key points there again, 39.44, 30-year amortization, primary residence only, confirmable income only. So you're looking at your cookie cutter style guys, okay? Your cookie cutter style clients that are just maybe missing out. Very similar to First National Excalibur, okay? But that's kind of where we had our initial launch, okay? You'll see our rates coming up in the next couple of slides here, as well as you'll also know that we do have a 20 basis point promo on our 2-year offerings. So stay tuned for that. When we take a look at our lending areas, obviously this is Ontario based only. We do have an appetite in rural properties. General rule of thumb, A, location population of 100 grand or 50K in radius. B, sorry, I got to move this little slide here if I can. There we go. Perfect. B is 50K or 25K in radius, and C is all others. I can tell you that when we're looking at C, the majority of the time they want to use about 65%. My ask is, when we're looking for exceptions, especially in those rural areas, tell me the good, the bad, and the ugly of what your deal looks like. The amount of times that I get an email that says, hey, Chris, will you entertain this property? The answer is probably, well, maybe. I just need to know about everything, right? So usually if you're flipping me over a property, there's usually a hiccup with regards to it or something you know about. Tell me about it. Either have a conversation or shoot me an email. In addition, when we're looking at pricing, when we're looking at LTVs, when we're looking at a property or a deal as a whole, I always like to know everything about your client, okay? We're going to focus your deal on the good. We're going to mitigate the bad. I do want to know about the ugly. I just want to make sure that we can mitigate that so it doesn't cause any hiccups when we get to close to funding, okay? We can get commitments out all day long. We do want to fund those deals because that's when you guys get paid. That's when we obviously see more success, etc. So just getting an approval, great, but let us know the good, the bad, and the ugly so we don't have any hiccups when we get closer to funding time, okay? Now, when you're sending me information with requests to the deal, let me know what the incomes look like, how you're calculating the income. Let me know the loan to value you're looking for. Beacon scores. When I take a look at Beacon scores, I'm not overly concerned with the actual score, but how they got there, right? I could have an 800 Beacon score, but I've had one trade line for 2 months. That's not a true definition of an 800 Beacon score. I could have, a 600, never missed a payment. It's just I'm a small business owner that gets my credit checked quite frequently for different products. So, that would drive down my score. That's not an indication of a true 600. So let me know what you've got and what we can do there, okay? Let me know any derogs, obviously. If we've had any derogs on a mortgage in the last 12 months, major exception for us to get that deal done, okay? In addition, Adam's heard me say this a few times, let us know the liquid savings that they have, okay? So we want to know checking, savings. We want to know TFSAs, RSPs, non-registered investments, that sort of stuff. I see a ton, and I mean this, a ton of requests that come in, and it'll be a negative 90,000 net worth, and all of a sudden they've got $120,000 of household goods. Household goods aren't helping us in this case. We're really looking for those fallback assets when we're looking to do it in an interesting deal, okay? I can tell you whether it's the A side or whether it's the alternative side, liquid savings go a long way. If they don't have them, they don't have them. But if they do have them, let's make sure we mention those because that helps us get a lot more exceptions when we're looking at things, all right? When we're looking at our Aspire Alt-A, again, this is our traditional B-side stuff. We purchase refis, ETOs. General rule of thumb is 200 grand is kind of our ETO max. We will go above that if we can look at solicitor-controlled funds, okay? In addition, I also like to bring forward couple housekeeping things. We do not report on the credit bureau. Okay. So we do not report our mortgages on a credit bureau. We register our mortgages under Computershare, very similar to how Adam does it. We do not have a bona fide sale clause. So therefore our penalties aren't too bad to get out. And we do have 15/15 prepayment privileges. Okay. We do ask to collect the property taxes on all of our Aspire deals. But let's not lose a deal based on that, okay? So if a client's adamant about, hey, I don't want to pay my property taxes with my mortgage, I'd like to pay them separately, reach out to me, let's have a chat about it. I can tell you, if they're an 800 Beacon score, 70% loan to value, have a great credit history and all that sort of good stuff, we'll probably allow it. But if we're doing a refi for somebody and we're paying out behind property tax, I can tell you that's not going to happen. Okay. So we look at these as case by case, but please let's have a conversation about it. Obviously, our maximum loan to value is 80%, and that does include registering a second behind us for obvious reasons. Okay. 70% on rentals. We have gone a little bit higher on that. I won't go to 80 on this time, but we will go to 75 on this property or on this product. Please note, with regards to Aspire Alt-A, we do have a max at 5 doors, okay? It's not 5 addresses, it's 5 doors. So if Adam has an owner occupied and he's renting out his basement, that's classified as 2 doors. So we could either get Adam, 3 single family rentals or a duplex and another rental, but we're capped at 5 doors. Truly hoping that we can push the envelope on that and we can really start to expand it. But right now, our top tier product capped at 5 doors. Minimum credit score to be able to use any sort of income is 540. Again, are exceptions available? Yes. It's going to depend on the loan to value, the reason why it's gone down that low, etc. All right. Max ratios on this side are 50-50. We will go up to 60-60. However, we're going to slide the loan to value back to 65%. Okay. So if you've got a deal that's just slightly above, let's have a conversation about it and let's see how we can work it to try to avoid going over to the 60-60 type. Okay. As I mentioned earlier, contract qualifier is 2, 3, and 5 year. We do have a 5-year no option available, as well as we've got a 2 and 3 year available as well on that as well. Oops, sorry about that. Well, I'm just trying to move something else that was there. Our BFS bank statement program. That's where we're going to get into. Oh, nope. Sorry, they changed these slides up on us. When we're looking at our BFS banking statement program, a couple things that I need you to remember. First of all, about 18 months ago, the regulators went into a lot of the top alt lenders and said, hey, we like the 6 months bank statements, but we really like the 12 months bank statements. So you've probably seen a shift from a lot of those folks from 6 months to 12 months. We're no different. We're looking for 12 months BFS banking statements. Couple things to note. We do prefer business bank statements, but if you have personal statements, let's have a conversation about it. And the example I kind of use is, if I've got a part-time job and, I do some woodworking on the side, pulling in about 15 grand a year, I'm okay to have that going into my personal account. But if I own, a hotel chain, it wouldn't make a lot of sense for me to be dumping that money into my TD everyday checking account. Okay. We'd want that separate. What we're trying to do is make sure we understand the expenses versus the deposits and all that sort of stuff. So it's really tough to gauge when they're going into a personal account, but please let me know if it's personal or business when you get it. Now, the question I normally get is it a hard and fast stop when you've only got 8 months of bank statements? What we're looking for is continuity of the income. Okay. So if Adam worked for, an IT shop, he decided, I don't want to work there any longer. I want to be my own boss. He goes out, and when he was an employee, he was making about $85,000 a year. He goes out, subcontracts back through the same shop, contracts for $85,000, but we only have 7 months of business bank statements. We're still going to entertain that deal based on the fact that there's continuity. Okay. So if somebody's new to the industry, we want to know about that. The ones that are really tough for us to do would be, I was a former server at a bar. Now all of a sudden I've opened up a mechanic shop and I don't have a history of that. That's going to be, we would like to see the 12 months. Okay. Please note, we do look at an expense ratio. When I look at, for example, an IT professional, probably 10 to 15%. If I run a coffee shop or a bar or a restaurant, probably 40 to 50 just because of the overhead. All right. For any non-subject rental property, we use the same rental worksheet that Adam provides. So it's the exact same there. And when we're looking at doing an actual rental property, so if the subject property is a rental, we're going to use 80% add back. Okay. So 80% of either the leases that we've got or the market rents. Please note, we do have an approved appraisal list. And this is the one ask that I ask of everybody I talk to. If there's somebody you utilize on a regular basis that you don't see on our list, please provide me their information so that we can connect with them. We've been trying to expand our roster for appraisals for a while now. Some people return our calls, not everybody. So we're definitely looking for somebody to do that. Okay. Appreciate that. That's basically our top tier product. As it looks today, it's going to be completely different in the coming months. I can tell you our top tier, we've got 3 more investors on board, and it's not just about here's the money, guys, go out and lend it. We got to make sure that their credit criteria matches ours. We've got to make sure that their values mirror ours as well. So it's not just about getting the money, because we do have a lot of liquidity. We just got to make sure that we have the right liquidity. All right. Once we get down past our traditional alt side, we look at Aspire Advantage. Aspire Advantage, rates are starting in the mid 8s with a 2% fee. Okay. Fee is split between us. You get a point, we get a point. This is a very much product right before you get into that traditional mix space. I classify it as a mix private side, very similar to that. Our number one selling product that we have here on Aspire is our rental program. Okay, so it says it's designed for experienced real estate investors. Definition of that for us is that they've had a rental property for at least 12 months. Okay. The beauty of the way that we look at our Aspire Advantage rental program is we're just looking at DSCRing the subject property. Okay. So a couple things to note. If Adam and I are buying a rental property together under the Aspire Advantage, at least one of us has to have an owner occupied. It's not designed for my niece who lives on my parents' couch or something along those lines. At least one of us has to have an owner occupied. Please note, we do not factor any of that into our ratios. So there's no traditional GDS, TDS. We are just looking at DSCR, the subject property. So I'm going to say that Adam, Adam's a realtor. And obviously, realtors generally make really good income. They pay themselves into a corp. And by the time they file their personal taxes, they've whittled that income down to about 20K. Meanwhile, Adam's got 10 rental properties. We're not looking to debt service all of that, right? We are not, I don't care. I do not want to see 10 mortgage statements from them. Don't want to see 10 tax bills. Don't want to see 10 leases. What we're looking to do is take the gross monthly rents or leases if you've got it. So either market rents or leases, less principal, interest, taxes, and heat if applicable. Obviously, if the client's paying heat, then that's fine. Condo fees, obviously, if it's a condo. And if that washes to 1, so if the DSCR is at 1, we should have a deal, okay? The interesting part about all this is I don't want to see income. I don't need to, if the client's got a lot of debt, I don't care about that. Obviously, Beacon score has to be okay. We're looking at around 600 and above. But we will do a lot of other unique things with regards to our DSCR product. We will allow for holdcos. My ask is if you're doing a deal in a holdco name, put that in the notes because a lot of the systems won't allow you to submit it in unless you can tag a credit bureau to it. So put that in the notes. This property will be filed underneath holdco, whatever the number is, okay? In addition, we'll also look at very unique style properties, meaning we will look at your student rentals. We are looking at your Airbnbs, your short-term rentals, your boarding houses. We have an appetite for those. I will throw out, if I'm going to do a deal for Adam and he's going to convert it into a student rental and it's a property that we would generally do 75%, we're only going to lend 70 because we do take away 5% based on the fact that it's a higher risk product, whether it's a student rental, Airbnb, or something along those lines. Again, rates are more mixed style. You're starting in the mid 8s with a 2% fee and going up from there. I would say that on average right now, I'm seeing a 1 or a 2 year in around that 9% range with a 2% fee. Again, that's split with us. And you can go to 40-year AM. Okay. So under Aspire Advantage, we offer 40-year AM on this. Okay. When we take a look at our business for self product, we're looking for 6 months minimum of bank statements. We will get away with 6 months and annualize them. But what I like to say is minimum is just because if I was looking at a landscaper, landscaping really hasn't traditionally started yet. Obviously, I'd want to see 12 months just to see where they've got. Again, liquid savings always help with these type of deals. In addition, if there's any sort of contract, that really speaks volumes as well. All right. So again, we're looking for 6 months of bank statements. If you got 12, that showcases a great number. Give me the 12. But if you only got the last 6, because that really helps the deal, please make sure you send those over to me and we can take a look at it. If you've got, third-party prepared financials, so we can take a look at those as well, and we can use that number. But just keep in mind, I don't generally want to see an NOA. I don't generally want to see the full T1s because a lot of times they show me way too much stuff, okay? We will go to 60/60 GDS, TDS on this side, all right? All I can say is when you're sending me off an inquiry, the more information you give me, the better the conversation can be. I see, like I said, a lot of times we start to find out stuff once we get closer to the goal line or once we start the underwriting process. My ask has always been, please let me know what you've got on your desk. And again, the good, the bad, and the ugly, because I don't like surprises. And I know that a lot of you guys are probably, COFs have started to drop again. I'm seeing, 2 and 3 day COFs again. So if we can't do your deal, we want to make sure that we get you into the right spot. So just let us know upfront what you've got. Our underwriting process is very simple. You send it in. It's LOB, obviously B. Aspire will drop down as well. First thing you'll notice is once the deal comes in, our underwriters are going to send you an email. Hey, just want you to know I've got your deal. So please make sure you include your email and your cell phone number in your notes. Once the underwriters start looking at your file, they're going to pick up the phone and they're going to give you a call. They're going to say, hey, this is so-and-so. I just want to talk about the deal. It really eliminates the back and forth on a lot of the files. Because again, we are looking for speed, efficiency, just like you guys are. So our underwriters are programmed to pick up the phone and they do one heck of a job talking to you about the files and kind of going from there. Right now, turnaround times 24 hours or less. I saw 2 deals come in this morning that have already been communicated. So we are very on top of our stuff. In addition, we like you to be broker complete 5 business days before. That way we can ensure a smooth closing. Obviously, if there are exceptions can be made. That's kind of where we sit today. We're first mortgages only. We're hoping to get into that secondary, second mortgage type market. And I want to see an equity style deal coming down the pipe in the future. Stay tuned for that. If you're not receiving any of our emails or from our CRM or myself, please make sure you flip me over a quick note and I'll make sure that I add you on. All right. Adam, I will pass it off to you. If there's any questions, you can just give us a shout there at the end. Sorry, I'll get this off the screen for you, Adam.
Thanks, Chris.
Adam, I'm going to add you as a presenter. Do you have presenter rights?
I'm going to stop sharing there.
Okay.
Let me
I just
see.
made you a presenter. So you should have all the bottom controls there.
Yep, I see the bottom controls. Which button would be? Oh, share. Here we are.
Yeah.
Share files or share screen?
Share screen. Well, you can share some files. What do you got there?
Oh, here we are. We can't show you those files. Where is it? I did this before, and I couldn't find the. The window I wanted to use.
So you can click cancel, go back, press the button again, and then go at it again.
Oh, let's try it again. Share screen, share window. Nope. Okay, let's try entire screen. Can you see my screen? You guys see that?
Yeah, it's it's there now. You're good. Just full screen and you're set.
Okay, slideshow. Okay, so can you see me changing the screens? You guys see me changing the screens?
It works fine.
Yep. Okay, perfect.
You just want to get rid of that nubbin at the bottom that says stop sharing and just click on hide instead.
There we go. Okay, so I'll jump through a couple of things real quick, just because Chris had already touched on about Strive. We're an MFC. Obviously, I cover the A side. Our bread and butter at the moment on the A side is insured, insurable mortgages. We do have an uninsured program. It's on its, I would say, training wheels at the moment. So it is pretty basic. Owner occupied only, 5-year term only, and full income qualifying. So we've just sort of launched it. So we're kind of gaining steam with it. Probably the biggest thing with it right now would be a benefit is that we will do an AVM. So we'll try an AVM right away without going to an appraisal. If it gets a hit, obviously no appraisal needed. If you do need an appraisal, we don't have an approved list on the A side. You choose your own appraiser as long as they're accredited. Okay, so anytime that I'm talking about needing an appraisal through this process, you can choose the appraiser. So we work with all 3 industry insurers, CMHC, Sagen, and CG. Okay, CMHC, we usually use them mostly for new to Canada and the CMHC Enhanced program. So if it's outside of there, we'll most likely use the other 2. Use FCT for closing. Anybody that's not familiar with FCT, what they will be doing for us is when you instead of your client having to get a lawyer and us getting a lawyer, we use your client's lawyer and we transfer all the closing documents through FCT to your client's lawyer for purchases. And on transfers, we use FCT to facilitate the process. Okay, so they act kind of like our legal side, if you will. Quick couple things. Minimum mortgage amount $100,000 for us. We do all the lenders, all the insurers products, owner occupied, second home, rentals, vacation homes, flex down, stated income, purchase plus. I'll talk about those ones a little later. 120-day rate holds. We do pre-approvals. We add 20 bips to the premium, to the rate. And we do allow rate drops. So one-time rate drop is what you'll see in our marketing material. We can allow additional rate drops. You just need to come to me instead of your underwriter for that. Okay. Another quick thing is that not on here is we do have a client portal at the moment. We don't have a broker portal. And so 7 to 10 days after closing, your client will receive an email with the portal details. And on there, they can see the mortgage amount. They can request extra payments, change their payment frequency, and all that kind of stuff. Anybody has any question anytime, just jump in as I'm going along here. A couple of niche things for us. Obviously, we'll take child tax benefit up to age 14. It needs to be valid for up to 3 years into the term. So you could almost hit up to that 15 in some cases. For non-subject properties, we allow your client to have up to 6 rentals, 8 properties in total, which is not usual for an A lender. I believe we're the only ones that do it on the A side. And for non-subject properties, we have a rental worksheet, which gives you an offset. And a change we recently made, which is actually having a really big effect right now for qualifying, is if your client owns a rental with somebody else and that other person is not on the current deal, we'll still use 100% of the rent to offset the cost of the property, of the non-subject property. Okay, we just split the surplus by the number of owners. Any clarification you want on that, feel free to reach out to me. We don't mandate the collection of property taxes, and that goes for high ratio as well. House plus 15 acres. So if you have larger properties, we use a little more value. We don't really have a limit on the property. It's got to conform to the area. We'll also consider hobby farms and ag zoning. We just need to be comfortable with the fact that it's not going to be farmed. Okay? As I go through, what you're going to see here is a theme that we are a very reasonable, flexible lender. So I know it can be hard to believe for insured insurable, but we do a really good job at sort of pushing the boundaries and trying to get to deals to work and working with our broker partners to get deals through. Right? We got to remember the insurers also want to do business. I think I've been guilty of this, always thinking about them as sort of big brother saying, hey, you can't do this, you can't do that. That's not really the case. They want to do business as well. They have to adhere to OFSI rules. And sometimes each one interprets it differently as well. And as Strive, really, we try to get deals to them. And so you'll see that that what differentiates us from a lot of our competitors is we actually try to work with you to get deals done, even if they seem difficult or complicated. Okay. Now, a couple niches we do have. I did talk about the number of properties, also our Purchase Plus improvement program. So this is a great product, especially if you work with realtors or you're looking to try to start working with realtors. We will allow you to go up to $100,000 in improvements. We will allow your client to do up to 3 draws, which I think if you're doing that level of improvement, that's a great feature because we don't require a client to show us that they have the cash to do the work. So they may have to borrow it from a friend or family. Maybe they don't pay for 6 months with Home Depot. Maybe if they're doing windows or something big, the contractor will give them, a net 30 days to pay once the work's done. So this kind of gives your client flexibility to get some of these larger projects finished. We do require quotes from a qualified contractor. So if you are needing this signed off with a COF, so your client's only buying this house as long as they do Purchase Plus, we need those quotes up front. So there's a great opportunity for you as well. It seems like a pain in the butt, but now you can go out to the contractors and say, look, I'm a mortgage agent. I have all these clients or these leads that come in. They're looking to do this type of program, and I'm looking for a great partner to refer them to. So warm leads. So right off the bat, just from this program, you've got realtors you can create referral partners from and contractors. You got 2 referral partners right there. Once the work is done, if it's usually $15,000 or less, we just get paid receipts, okay, showing the work is finished. If it's beyond that, we're going to need an inspection as well. And so you're going to call one of the appraisers. Again, we don't have a list, so you can pick who you like, and they're going to come out and do an inspection. It's not a full appraisal. We're going to give them a list of work that needs to be done. They're going to take some pictures. They're going to send us back a report showing that it was finished. We then tell the lawyer to release the funds, and the funds get sent to the client. If there's multiple draws, obviously you have to do that for each time there's a draw. Okay. Another thing I want to touch on in this program, you'll see it says 120 days to 6 months for completion. There is flexibility with that. We just had one 2 weeks ago where the client did their first draw and we had closed it in August 2022. Now, I don't promote it. We don't, want to promote that too much, but we're getting paid. They're paying the mortgage, so we can be flexible as long as you keep us up to date, right? Couple of highlights on this that's not you don't see on here that I want to bring to your attention. You've got to remember when your client is buying and doing a purchase plus, the new value is the purchase price plus the improvement. So if your client's buying for $500,000 and they're adding $100,000 in improvements, the new purchase price is considered $600,000. So the down payment is based on $600. The reason I picked the 5 and 600 mark is because that's the transition of where they have to put more down, right? So for the first 500,000, they got to put 25,000 down with 5%, 25,000, and then for the next 100,000, they got to put 10%. So the total down payment would be 35,000 on that deal. Okay, so it's important to remember that when you're looking at those these type of deals to make sure your client does have that extra kind of money if they're doing that big of an improvement. Okay, a couple things you can do improvements on. Obviously, kitchen, windows, flooring. You can do your own work, by the way. We just don't pay for it. So if your client wants to buy the material for the flooring but put it in themselves, we'll pay for the material, but they can't include the labor. Decks, septic systems, we have done nub and tube in the past on exception. Okay, so rather than doing a holdback, instead of your client having to come up with an extra $15,000 because they're doing a holdback, we could do it as a purchase plus. Okay? Saves your client money, probably saves you a few deals that way too. Another big one we just changed to this last week is you can do rental suites with this. Sorry, I'm going to sneeze. Bless me. You can do rental suites with this. So you can, if your client is buying a home and they want to put in an in-law suite or they want to put in a rental unit in the basement, you can use this program to do that. And now we can consider the projected income from that rent. Now, there are a few stipulations to that, such as we're looking for your client to have liquid fallback, or maybe there's a contributory income we're not considering. So maybe mom and dad are living with them, or so let's not even say mom and dad. Let's say an older child is living with them and they're working. We can't use contributory income, but if they're building the basement suite for them, we could then say, okay, well, that basement fair market rents will be $1,500. They do have a child that's currently contributing, living in one of the rooms, that's going to go in there. So we feel comfortable with that. Okay, so that's the kind of thing we're looking for, that fallback. Also should be a strong client overall. Okay, we're not looking for those borderline clients for that. Okay, that's all covered on Purchase Plus. If you have any other type of improvements you want to ask about, please reach out. I'm more than happy to talk about that. There's quite a long list of things you can do. There's also a few things you can't do, like putting a hot tub. Pools 99% of the time aren't going to fall into this. It needs to add value to the house. Okay. New to Canada, won't touch on this too long. We do the program. I think there's lots of opportunity for this. Obviously, this is where your client has been here within the last 5 years. They've moved to Canada. They have a work permit and or PR. Okay, then they have minimal credit established. Right, that's kind of the crux of this product. And so we're going to look for alternative credit, as you can see there, preferably 12 months rental payment history and utility payments. There are alternatives we can find for that. So if you don't have that exactly, please reach out. And that's for 5% down. For 10% down, it's even more flexible, as you can see. Two features on this that I wasn't aware of until fairly recently. If your client has been here for more than 5 years, but they came as a student, we can deduct that amount of time they were a student, okay, off of the off that 5 years. So if they've been here 7 years and they were a student for 3, then we could say it's actually only been 4 years in order to qualify for this program. Okay, so when you're talking to your clients and you're doing your initial intake of the application, you want to make sure you ask those questions. Okay, you're new to Canada. How long have you been here? If you're on a work permit, how long is your work permit good for? Because there are some government rules now where it's got to be more than 183 days in order to be able to purchase in Canada. And then the last thing we'll talk about on this one is down payment. 100% can now be gifted, and we do accept gifted funds from outside of the country. Okay, depending on the country of origin, we're going to need additional documentation. But the bare minimum is going to be a gift letter, wire transfer, and funds in your client account. Okay. Stated income, business for self. I usually spend the most amount of time on this one. It is probably the most complicated one because it's the most gray area one. Okay. This is where your client is needing an insured or insurable mortgage. Could be more than 20% down, could be less. So the stated income program is a minimum of 10% down with 5%, at least 5% from the minimum resources. We're going to take your client's last year's notice of assessment, and you're going to tell us what their last year's gross income was. We are then going to choose a number between those two that makes sense. Hopefully that helps qualify the deal based on their liquid assets, their credits, length of time in business, type of business. Okay, is there a cash component? Are they sole proprietor? Are they incorporated? So we're going to look at all that. So what I'm getting at here, it's all about the story that we build around this client. So when you call me about one of these files, which you probably will because each file is different, I'm going to ask you those questions. You're going to say, hey, my client is a contractor. I'm going to say, okay, well, what kind of contractor are they? How long have they been a contractor for? Do they have employees? Is it just them? When you're telling me the gross income, or your client's telling you the gross income, does that include materials? Is that the gross billings, or is that their gross income after they factor out materials? Okay. Do they do only commercial type businesses, or do they do a mixture of residential and commercial? Because if they're doing just commercial, there's probably not a cash component. If they're doing residential, some people like to pay cash, right? Whereas commercial businesses want to see it go through the books for the write-offs. So you got to ask these questions. Then you're going to get, although we don't ask for the T1s, I would get those statement of business activities, get the T1s. If they're incorporated, get all that information as well, because there may be something in there that could help us increase the amount. So an example uses, we had a client, the contractor, he showed 20,000 on his 2022 NOA. Okay, so we're like, well, they wanted to use 100,000. It's a stretch. Is it doable? For sure it is. We need to ask the questions. So what we found out is in 2022, the client had written off an $80,000 truck. Why the accountant did that, I have no idea. But in 2021, 2020, the client NOA's income was 60,000. So we went back to the insurer, said, look, this is a one-off. This is what happened this one time. If we look at previous history, we've got a higher NOA income. We've got gross business income that's trending upwards. Year to date, they're also trending upwards. So we feel that although we're saying going from 20 to 100,000, we're really kind of going from 60 to 100,000. Client's credit was good, had a decent down payment, had a little bit of money left over. So when you looked at the whole profile, it made sense that he would be bringing that kind of money. Okay. So again, you got to look at that. If your client's telling you, hey, I'm a truck driver that makes 180,000 a year and my NOA shows 30, but when you factor everything in, I'm really making like 100, but they have maxed out credits and they have bare minimum down payments, maybe doing this for 10 years, you got to ask yourself, okay, well, where's all the money going if you're really making that kind of money? And that's the kind of questions we're going to ask so that we can figure out the deal and get the insurer on board, because that's what the insurer is going to ask. Okay. So that's the stated income. It's all about the story, get all that information so we can build it up and show how it makes sense. Okay. So those are for people self-employed 2 years or more. Okay. If they're self-employed for less than 2 years, we have another program. It's called the CMHC Predictive or Enhanced Program. That's we've been self-employed for 6 months or more, up to 24 months. And they have a previous history of being in that industry. Okay. So this one isn't stated. We're actually kind of showing the numbers. And what we're doing is we're going to get 6 to 12 months bank statements. So if they've been self-employed for 6 months, we're getting 6 months bank statements, and we're using the gross deposits from those 6 months. Okay, if they've been self-employed 8 months, we're using 8 months bank statements, deposits from 8 months, and then obviously so on. We're then taking a percentage off those gross deposits. And that percentage, there's a small kind of crude grid we have. So if it's like an IT professional, they're offering a service, we have 20%. If they own a restaurant with 20 employees, we're going to take off 80%. The expenses are much higher, right? We then take that percentage off. We take that number, we compare it to previous year's NOAs when they're employed, and how does it line up? And how does it line up with what they do? Okay. The next thing is ideally for this program, we want to see contracts as well. Because what we're doing is we're, as I said, we're predicting the income, right? So based on the information we can have. So the more documentation we have to show what they're likely to make, the better. So a contract is going to say, so if you have someone that's been self-employed for 6 months and they show that they've brought in $80,000, and then you say, hey, look, I've got this contract saying they're making $80 an hour for the next 12 months on this contract, then we can say, well, look, here's the contract. We can back it up with the bank statements. They're going to keep making this going forward. Contract has a renewable clause maybe to it. Or maybe if we look at the past, we can say they were an IT person with a Scotiabank and they were making $110,000 a year. So this kind of all starts lining up. The incomes are close, right? Plus, I will say there's a bit of a cheat with the IT. We see so many of them. We kind of, I could probably tell you what all the contracts look like. They're either 65, 75, or 80. So there's a few outliers to that, but they're all pretty much that. So that's kind of what we're looking for the enhanced. Preferably a contract. If not, that's okay. But we should have a lot of history in the background from previous history of what they're doing. So if they're a contractor, maybe they were an electrician for 15 years and now they're an electrical contractor. Okay. And then we have the bank statements back it up. Both programs, you should have very good credit. I would say 700 plus. No DROGs. If there is something, it should be a while ago and easily explainable. Okay. Because we are stating the income on these, or we are kind of projecting the income a little bit on some of these. Okay. So that's the self-employed program. So just takeaways there. It's all about the story. We can do it as insured with less than 20% down, right? And reach out to me if you have one of these deals. We do have a template I can send you where you can fill out. There's some questions we ask you. We actually ask you to put that into the notes as well. It helps the underwriter prep the deal for you, right? Collect as many documents as you can.
What if you're transitioning from a sole proprietorship to a corporation and you've been a year with the T225 and then you're transitioning into a corporation? So now you're basically just dividend and salary, if anything, or dividend and payroll income.
Yeah, that's okay. Yeah, so what we do is, okay, so I did touch on that. So if you're, let's say you incorporated in January 2024, okay? We would still go back and look at the 2023 NOA and gross income as a sole prop, and we would do it that way. If you incorporated partway through 2023, it gets a little more complicated. We're going to have to look at, what did you make as a sole prop up to that point of incorporation? And then we're going to look at what the retained earnings were in the corp. Okay.
So is there a percentage of the retained earnings you're going to be okay with, or is it the full amount of retained earnings?
We can look at the full amount. Usually I say to be on the safe side, we kind of look at the net retained earnings from that year. So you would say, okay, if in 2023, the whole year they were incorporated, they paid themselves a dividend of 50, they had a net retained earning of $75,000 they left in the corp. We would then say, okay, we're going to state the income at 125. Right.
So for everyone's sake, it's a good idea to collect your T2s, because I know Sagen has asked me for T2s before. And though it's not a part of their criteria, though typically they don't want to see that, but they will ask for it. So at least have your paperwork ready. So get the T1s, get the T2s, so you have everything on point. You don't always need financial statements. You can actually get away with T2s, because if you did financial statements, there's got to be a corporate return that they filed either way. And that's just an easier document to obtain from the customers.
Yeah, we just need to see what's happening, right? And so we can comment on, okay, does this make sense? What you're trying to tell us, what we're trying to use. Yeah. And to Ali's point there, right? Getting all those documents, it's not just are we going to ask you for them. It helps you structure the deal properly and come up with a very concrete argument that helps mitigate risks. So when when you send us the deal and we're trying to talk to the insurer, if we feel confident in you, in your ability that you've really looked at this deal and you package it properly, we're really going to ask less questions, right? Because we have more trust in you and what you're telling us. If we ask you for something and it takes 2 weeks for you to get it, we're going to start going, okay, well, what the heck's going on here? Maybe we should look at something else, like look at other things, right? So you got to remember that. Like if you have all that information, you can package it properly, answer the questions right away, and know your deal really inside out. That goes a long way in helping getting your deal approved and getting that little extra income that you need for your client. A couple more programs I will touch on. We do have it's an insured program. It's a projected income for your physicians, dentists, and vets up to 24 months after graduation. For physicians, we will look at first, second, third, and fourth year residency as well. Okay, so there's a different income for first and second that we'll use than there is for the third, fourth year physicians. So purchases and transfers only, 10% down. And down payment can be from savings, gifted, or borrowed. Okay. For professional lines of credit with balances 50,000 or more, we will treat it like a HELOC. So balance, 25-year AM, 525 rate. Okay. So to give you a quick idea, if you have a dentist that is 6 months into their practice and they're telling you they're making 50,000 a year, we're going to use 185. You need to show us that they're licensed, that they're in practice. Right. Same with the vets. If you have a first-year physician that's in residency, we're using 180. Okay, you just have to show them they're enrolled in school. Okay, so this is a great program. I think I find the banks really kind of lock these people in, and so this gives you at least some ammunition to try to win those files. Okay. Transfers.
Just for everyone's benefit here. This is all insured and insurable. So anything under $1 million is what your loan amount is. You're not looking at anything over $1 million. These transfers are like physician trying to get a $1.9 million property out of BC. Not going to work. This is specific to insured programs and insurables only. And in case of transfers, you haven't come down to that, but just want to create a difference for everyone's understanding. So a property valued at 1.5, customer comes back, says, no, my property is valued at 999. My loan amount is just like 500 grand. Can you fit me into the insurable? What do you do?
What do we do? Well, if you submit the file to us, are you talking to me or are you talking to your agents?
No. I'm talking to you. I'm asking if we have the ability to price down a property and the client is adamant on an insurable product, he knows he's going to get a better pricing out of it, especially based on the loan to value. You clock it down back to 65 LTV, and you have a lower pricing as good as a high ratio. So how do you underwrite that? Do you use the value that we put on the application, or are you going to use the AVM to figure out, okay, well, the value is 1.5, we can't use it?
We use the value that you put on the application, but remember, it's going to go to the insurer. The insurer will run an AVM on it. So that's the risk you take on that. Like we're not going to know. We're not going to go and say, hey, we're not going to look up the address and say, well, we think it's worth this, because we're not experts. We're not appraisers. And also, if we did that for every deal, we'd fall behind too quickly. So if you tell me the value is $995,000, then to transfer, we're going to submit that to the insurer. And if they're okay with it, then that's the way it's going to go. Because remember, like, value is subjective too, right?
So coming out of a 30-year, he's paid down 5 years. He's now looking at a 25-year. You're saying most cases where we would be able to qualify that product as a transfer, as an insurable, you're okay with it as long as the value is under $1 million.
The value's under $1 million, yeah. We will send it to the insurer to get approved. Where you might run into issues if the insurer comes back and says, I don't think it's worth that. It's worth more. I've seen that happen, and that can happen, and they don't like it when they see that. But again, again, as we talked about, value is subjective. So whereas the client, you may think it's worth that, or the client may think it's worth 1.5, it may not. It may be worth 1.2, or maybe it is only worth 950 because we just went through a huge period where we had massive growth and a lot of things have dropped in certain areas. So I would say we're going to take what you put on the app and we're going to submit that. Now, I will touch on that is if that same client come to you and said, hey, I've got let's say a client comes to you and said, I have a $2 million property and I bought it in 2010 and then I refinanced it in 2015 and at that time it was only worth, $900,000 and since then they've only renewed, we can do that mortgage. No, we can still do that. As long as they refinanced or bought before, I think it's October 17th, 2016.
2017. 16, 17. I think it was 17.
2016. Yeah. They can still, we can still transfer that. Right? As long as they haven't refinanced it or as long as they haven't refinanced it before, after then, or as long as they bought it before then. They haven't done anything since that time. So that's one thing to remember. If you see that, if you have a client that comes to you with a transfer with those over millions, ask those questions. Okay. Obviously, we do both standard and collateral transfers. We can cap up to $3,000 onto the mortgage. We cover the FCT fees for both. For collaterals, we take 10 bips off the commission, and we need at least a minimum mortgage amount of $250,000. A lot of that has to do with the fact that the cost to do a collateral transfer for us is just about double it is to do a standard, right? If you're doing a collateral, you can re-amortize back to 25 years. So say your client's got a mortgage with CIBC and they have 15 years left and they want to transfer it, or you want to transfer it over to us, you could re-amortize that back up to 25 years. You can also add, remove child, spouse, parent, grandparent, grandchild on a collateral. There's an extra $625 fee to do that, and that will be the client's responsibility. For insured transfers, it's good to remember that you can qualify a contract rate. That changed last October. And also, if you have a client that has a single family rental that was previously owner occupied by that client, we can transfer that over as well.
So if I can just interject and make this very clear, you are not using stress testing on transfers
that are insured. Insured transfers do not have stress tests. It's contract rate qualifying.
Whatever your contract rate is with Strive is the one you're going to enter on the application. You're going to use the exact same rate on the qualifying rate as well and submit.
Yep. So right now, our 5-year insured rate would be $499. You're going to qualify them at $499. So I talked about the rentals. I talked about that twice in there. And the 3,000 fee cap. Big thing, anyone that hasn't done transfers before, I will throw it out there that, please immunize your clients about the fact that, there could be some bumps in the road near the end. And the reason I say that is the current lender they're with is going to try and keep the client, obviously. So as you get closer to closing day, the time that their mortgage up renewal, because we're going to try and line it up, you're going to find that some lenders will delay getting the payout statement to FCT, right? And FCT needs that in order to complete the transaction, get your client signed up. So just be aware of that. That can happen. So you just prepare clients so they don't get frustrated. It's not uncommon for a transfer to close a few days after the renewal date of their current mortgage. And so that per diem amount that they're being charged could be capped onto the mortgage as well. Okay, so transfers are great products, great way to make some great products for you guys, but just to remember to prepare a client for that because it's going to go really smooth at first, and then these bumps in the roads are going to happen at the end. And so just be prepared. I would like to touch on the fact we do have bridge loans. Okay, so if you need bridge loans, we do have them as a fairly new lender. Not new lenders have this, and we do have it, and I want to just point that out. Okay, we do have bridge loans. Process on the A side, you're going to submit through your to the system that you guys use, and it's going to come into us, and the underwriter's going to pick it up. They're going to reach out to you, let you know they have the deal. At which point, if you have documents you want to send in, you're going to email them directly to the underwriter. Okay. The underwriter's also end-to-end, so they're going to be reviewing your documents, and they're going to be the ones communicating with you about conditions, right? If you have a COF and you have documents up front you want reviewed with the COF, for instance, income and down payment, which are usually the two biggest problems, you need to send it all in one shot. They're going to do what's called a one-time review. You're going to see that in the email. They're going to refer to that. What they mean by that is they don't want piecemeal. So if you want them to review income and documents, send them all at once in one shot. Don't send like pay stub and then the T4 the next day and then another email with 90 days bank statements. Send it all at once. Right? They'll review it for you with the approval and send it back signed off. Okay. Underwriters, FCT, obviously we instruct through FCT. If you want us to instruct prior to a file complete, let us know. We do need a signed commitment to do that. All right. A couple of our processes, which I like, which is if you've been in the industry for a while, I find it's a big deal, is our internal process is to, once the underwriter has signed off on the documents, it's to have our QA team review the documents then, rather than wait for file complete. Now, is that a perfect process? No, but that's the process that we look to implement so that we're not having last minute issues. We don't want to be asking you for documents the last minute, the day of closing. So we also need your cooperation to get those documents in as soon as possible. So we don't run into that, right? If a problem comes up a day or 2 or 3 before closing, there's not as much we can do to figure out a solution as if we have an issue, 10 days before closing. Last thing, compensation. We pay everything up front. We have unlimited buy downs for 3 to 5 year terms if you're into that game. Okay. You see the buy down rates there. 5 bips for of comp takes 20 bips of 5 bips of rate takes 20 bips of commission. One thing I didn't comment on for transfers, we will do 1 to 5 year terms. It's not limited, so we'll do 1 and 2 year term transfers as well. That's it. Customer portal there. We do have all our forms are on the strivecapital.ca website, along with our rental worksheets, which has the most up-to-date vacancy rate. So please check that out. Gift letters, the forms for transfers, and that are all there as well.
To the benefit of me saving time, if you can just help me out, Adam, straight from the horse's mouth. How quick is a quick close?
How quick is a quick close? I'm trying to get off here. Can you guys, how do I stop sharing my screen?
Click the same button.
Yeah, I don't see it anywhere. I hit it. Quick close. Quick close is going to be, I would say anything under 10 business days.
How much time do you need to be able to process that?
Like if you have a deal that's closing within 10 business days, you call me and then I'll tell you if we've got the capacity to do it. And then we'll need all documents up front. And it's got to be a fairly clean deal. We have done quicker. The big thing we're going to ask you is why is there so little time left? We're not looking to trip you up or anything like that, but we just need to know, is there anything that we should know that's going to affect the approval or cause an issue with the insurer? Once we get to closing, because we don't want to pull everybody in and get something done fast only to find out there's some sort of a hiccup last minute we can't close.
Just as a rule of thumb for everyone who is watching, make it at least a 3 to 4 week timeline. If it's anything under a 3 to 4 week timeline, politely say no or request an extension. The reason being, by the time you're done with document collection, there's always something or the other that's still outstanding. And when there's a lot of back and forth happening, a couple of weeks just go by and you won't know it. There's a lot of pressure from the clients as well. I'm not saying don't accept those deals. What I'm saying is on the B side, Chris is going to jump through hoops to make it happen. But on the A side, everything is cookie cutter. So if the insurer doesn't see it the way it needs to, it's going to come back as a decline. So it's easier to manage the client's expectations, especially in a market where it's a downturn right now. Up until the rates start coming down, it's going to be a favorable market for the buyer. So manage the expectations so you can at least request at least a 30 to 45 day closing as opposed to a quick close. We're licensed in the US as well. And I don't know if you guys know this or not, but in the US for escrow, we need 45 days. No ifs, no buts. Take it or leave it.
No, I know the States is so different. It's crazy.
Yeah.
I think I saw something they were talking about new innovations where they can close within 20 days or something. I was like, oh wow.
Yeah, that's apparently a new milestone. Okay, appreciate it, guys.
COFs,
go ahead.
Again, just going to throw that out there. If you're doing a COF, it's a more complicated file. Give us more time. If you're doing a stated income deal, give us a 5-day COF. Don't try to do a 1 or 2 days because there could be a lot of back and forth on it, depending on how well you package the file.
Have the paperwork ready. If you don't have the paperwork ready, you're going to go back to collect the paperwork at some point. It's just going to take longer. There's no workaround on that. A lot of the agents that are working with central underwriting for submissions, you have to have us review, and then it goes back to the underwriting. We need T2s, so we are that buffer that clears out fraud, because if you don't have a clear understanding of what you're looking for, you may not be able to spot it. And central underwriting acts as that buffer to ensure that we have the ability to weed out the crap that's coming through. So that's why it's important to have everything up front. For argument's sake, you get the T1 in, and then now you're waiting on the T2. I know exactly how long it takes to get the fabricated version of the T2s. So if I'm clocking it on, I know where it went and how long it took to come back. The point being, the client will try and force onto you documents that may not be kosher, and it is our job, your job, to ensure that before it comes through the gates, it's accurate. So keep that in the back of your head when you're working with stated. Very important, because anyone and everyone can just say, hey, my NOA points to $80,000-$90,000, but by the time we actually look at the business profile, the financials, the back-end research to it, that's when the can of worms starts opening up. Other than that, the Strive has some excellent products. I always talk about this, and in 2024, we're so hard and focused on the choice between good lenders and bad lenders. And I want to preface this back to what Chris had said. You're working with investors. He disclosed that one of them is actually a credit union. They're the easiest to work with. They want the business. They're comfortable with the locale. They know how operations work as far as lending goes. And the fact that Chris and Adam are by your side, and I want to compare apple to apple. Though the products are as competitive, the service is a million times better than Merrick's. And that is the number one reason why you want to choose a monoline who's going to have those multiple investors, because if it's not fitting within bucket A or bucket B or bucket C, there are a number of buckets that they can elaborate on and find a solution. No one has the up to 8 rentals. I know the DCR requirement under a worksheet, under a rental worksheet, is unique to Strive. So there's a lot that you can market in a certain way that's actually going to get you deals. The opportunity where you have up to $100,000 in Purchase Plus, that in itself is a game changer. Your market for that kind of a deal is not within the GTA. So you're going out in the boonies, you're targeting smaller towns, smaller cities on Facebook and Instagram ads, and that's where you're bringing up the conversation that, hey, $50,000 of a Purchase Plus improvement is available through this program. And Purchase Plus improvements are a freaking pain in the ass. They truly are as a broker. But speaking on your direct volume, if you have the ability to standardize the process, the 1 or 2 deals that you're going to do, you're going to know what to expect ahead of time. You'll have those contracts up front. You'll have the paperwork ready to go through. And then it's easier from that day onwards. You know how to educate the client, have that paperwork ready. So it can be a game changer as far as you getting into the contractor's business is concerned.
Yep.
Sincerely appreciate it. And
Okay.
we'll call you out again once we need a refresher. And then for now, this would be it. Thank you for coming in, Beth.
Thanks, Ellie. Thank you, everybody.
Sure.
Have a good day.
I'll talk to you guys.